What's happening, friends? Welcome back to Dynamo DeFi. My name is Patrick, and on this channel I talk about cryptocurrency, decentralized finance, and economics. Bitcoin has taken another leg down as questions abound about the solvency of major players in the space, including Celsius and Three Arrows Capital. In today's video, I'll go through the timeline of events over the past week that led to this crash, what these concerns were, and then what some of the next dominoes to fall could be. Let's get into the video. First, let's take a step back and look at where Bitcoin was going into the past week. Since the collapse of Terra, it had been fluctuating roughly between 28,000 and 32,000 and had overall been pretty stagnant, and some people even thought maybe it had found a bottom. And then on June 9th, June 10th, it started to dip at a faster rate than it had before, and this was prompted by several things, but the NASDAQ was also dropping, so you can probably attribute a lot of this drop to macroeconomic factors outside of the crypto market specifically. And then as it dropped, rumors started to percolate that Celsius, one of the largest centralized platforms for people to deposit money on and store other crypto on, was insolvent. And so these started off as rumors, but I think many people recognized right away that there could be some credibility to them. And to understand why, you need to understand what Celsius does and how it works. So Celsius is a centralized platform for people who want to get some of the benefits of DeFi without actually doing DeFi themselves. They claim 1.7 million people use it, and the number I've heard is that roughly $10 billion worth of assets are deposited on Celsius. And those assets are a combination of stablecoins, Bitcoin, Ethereum, assets like that, and then Celsius basically takes them, uses them in various DeFi strategies, takes a cut, and then gives the remaining yield back to their users. And so for those of us who are really into DeFi, the yield isn't great, but for people who have never experienced DeFi before or might not be interested or able to use it, earning something like 10% on stablecoins seems phenomenal. And I think these concerns about Celsius first arose probably around the time of the UST collapse because Celsius was using Anchor. People didn't know exactly how much they were using Anchor, how much of the funds they had there, and how many they were able to pull out before UST completely collapsed. But that was when these concerns first started to arise. However, people were still able to withdraw, and there were really no issues over the past 4 weeks as Bitcoin was steady. But then as Bitcoin started to drop and the whole crypto market went with it, something else happened. STETH, which is liquid staked Ethereum, also started to drop. And this is significant to our story because one of the ways that Celsius earns yield, in fact, a major way they earn yield on Ethereum, is they liquid stake it. And that people being able to redeem their assets is contingent on that liquid staked ETH being roughly equal to Ethereum itself. And a quick aside on what exactly liquid staked ETH is. Ethereum is a proof of work protocol right now that's transitioning to a proof of stake protocol. And Ethereum can be staked right now, but it cannot be unstaked until that transition is complete. And that transition is known as the merge. So if you hear about the Ethereum merge, it's the Ethereum beacon chain where Ethereum staked merging with the main Ethereum chain. But however, since people can't unstake it, there's a protocol known as Lido, which allows you to stake it by sending it to them, and they give you something known as STETH in return that will be fully redeemable for Ethereum when the merge finally completes. So there's your quick aside on what STETH is, and Celsius uses this STETH to earn yield for their users. Great, right? People deposit ETH, gets traded to STETH, they earn yield, and then they withdraw it as ETH. But what happens if they can no longer trade that ETH for STETH? That's what started to happen over the past few days as the market was collapsing. So you can see that it dropped all the way down to roughly 95 cents for each Ethereum. And so basically what that would mean that if everyone came into Celsius and tried to withdraw their ETH, they would no longer have it in theory. And so this is what started more of these rumors to circulate. And, who knows who originated these, whether they originated within the company or just from people being on-chain sleuths, but there was truth to this because you can easily observe this in the price of STETH. And so as these rumors circulated, people saw this, many people rushed to withdraw their funds from Celsius. And this prompted Celsius to pause all withdrawals on the evening of the 12th. So swaps and transfers between accounts were down, withdrawals were down. Basically, what they were trying to do was prevent a bank run. Problem being that there's billions of dollars locked in there, and this made people say, okay, maybe the situation is worse than it appears. And you can see that was the evening of the 12th, and look what happened in the 2 days after that. We were just down only from around 28,000, really all the way down to 20,000, and then bounced back briefly before continuing back down to 20,000. That's the price on Bitcoin, of course. And it got so low that Celsius was actually at risk of being liquidated, and then things would have been really bad. So they had 18,000 Bitcoin used as collateral on Maker, the largest position on Maker, and they were borrowing $300 million worth of DAI. And originally their liquidation price was $22,600. They were able to add collateral to get the price down. However, this was sort of a self-feeding loop, because as they got closer to this, people started selling Bitcoin because they did not want to still be holding it when Celsius got liquidated. And it's possible that there may have been some players who were also shorting the market for the purpose of liquidating Celsius. But in fact, there probably were. But that requires a bit more digging if you want to get into the details of that. But regardless of who and what was selling, people were selling because of sort of these concerns around it. Celsius was able to get their liquidation price down enough that they were not liquidated. But as of the time I'm making this, withdrawals are still frozen, and there are still questions about just how many funds they have to repay depositors and whether they have enough. And I suspect that whenever they do open withdrawals, if they do, money is going to flood out. And if they don't open withdrawals, then people will probably have a protracted battle fighting between owners of the protocol, investors, depositors, everyone trying to get their share of the pie. But that's not where the story ends, because as Celsius was collapsing, some of these ripple effects started to spread outward to the rest of the industry. And so on the 14th, that's when rumors started to swirl that Three Arrows Capital, which is one of the largest funds in the space, might actually be insolvent themselves. And these rumors have been less confirmed. It's been very tough to get information on this, but there are a number of things corroborating that there might be some truth to them. So Three Arrows Capital, if you're not familiar, they are a fund with, at their peak, around $18 billion in assets as far as people estimate. It's not totally known. And they are known for investing in such layer ones as Avalanche, Ethereum, Kusama, Near, Polkadot, Solana, Terra, and so on, as well as a ton of protocols that you'd be familiar with if you are into crypto and DeFi. So the idea of them going under would be insane to people because they're such a large fund. Well, apparently what happened was, first, they also had heavy exposure to STETH. And not only that, but they were leveraging up their assets to go leveraged long. One of the founders of Three Arrow Capital, Zhu Su, he has a theory of something called the super cycle, which was basically that we were in an extended bullish period for the crypto markets. And as a result, the fund was leveraged long. And as the market crashed, they got perilously close to being liquidated. And in fact, a big part of the rumor that was swirling was that they were missing margin calls. And this has not been officially confirmed. However, a number of reputable sources have corroborated it. And if we dig into some of the things that we can confirm, it does seem that at a minimum, something is going on. So let's see exactly what was going on. Well, the first thing is, you can see this tweet here, in the past few days, and this is somewhat reasonable, but usually the founders of it, Kyle and Zhu, are known for being extremely active. They haven't tweeted or liked anything in days. Zhu removed every coin that was in his profile. He deleted some of his social media. And then here is the real kicker. They dumped 30,000 units of STETH and reduced all their Aave positions. So this was on the 14th. And this is significant because remember, they were selling the ST-ETH at a loss. So basically, they were selling it for less money than they probably could get in a short period of time because they needed the money now. And there are several people who have come and said that they haven't been able to pay their margin. However, before saying that for certain, I would like to see a statement from them. Another thing that we have confirmed is that their Aave debt was extremely close to being liquidated. So you can see this was on the 14th. Originally, if ETH moved to $1,042, just an 11% move from where it was when this tweet was written a couple days ago, then they would have been liquidated of 223,000 ETH. And that is just an insane amount of ETH, worth hundreds of millions of dollars that would have been liquidated. And that's basically where we stand today. I mean, there's some more details that have come out allegedly about margin calls and how they were leveraging up and everything. But the fact of the matter remains that questions remain about whether they're insolvent and how much money they actually have. And so what now, right? Bitcoin is sitting around $21,000, and could more dominoes be getting ready to fall? Here's a few of the risks that I see, and I'm not saying these are necessarily going to be the next things to fall. It's possible that things could settle down for a bit. But in the interest of analyzing everything objectively, here's where I see things right now. The first people to watch are other centralized platforms. So things like BlockFi, things like Gemini, that allow people to earn yield on stablecoins, Bitcoin, Ethereum, and other blue chips. After what's happening with Celsius, especially if it's confirmed that they're insolvent, I would expect people to start to pull their money out of those. And you do not want to be caught as one of the people that's in Celsius now with your funds, with your money trapped in there. So I think that's number one concern. And this is not financial advice. I don't use any of those platforms anyways, but if I were, I would be pulling my money out right now. Wait a bit and without earning interest. The rates are relatively low anyways. And then once this blows over, one can always re-enter. The next people that I think are going to be important to watch are going to be people who have lent money to 3AC. So remember that the rumors that started about them was that they were missing margin calls. They were not able to make payments on their debt. So what happens if they default on their debt? Well, imagine that they have several $billion of debt. I don't know exactly the amount. The crypto market after this most recent crash is less than a $1 trillion market cap. It's around 900 billion. A default of several $1 billion in debt in a market that small is going to have massive, massive repercussions across the entire space. And so I would start by looking at people who have lent money to them. The next thing that I would look at is the coins that 3AC holds. So we can see here just a few of their investments. Some of these are liquid, some of these are not. Some of these you can see are companies that don't have coins. But some of these coins, if they're insolvent and they have to start liquidating assets, or as tokens unlock, they have to liquidate them, what's going to happen to the price of these, right? If they own billions of dollars of them. So that would be the next sort of potential domino I would look at. In these things, I wouldn't expect the catastrophic collapse that we saw in something else because there's no mechanism for that. But you could see continued selling pressure on them if they're having to sell their vested tokens over a long period of time. And the final domino that I'm looking at is stablecoin. So this is the total stablecoin market cap. We can see it reached a peak of around 189 billion and then currently sits at 155 billion. Well, what happens as people decide to exit the crypto market entirely? And people probably will, because the yields on DeFi have gone very low, sometimes 1-2% on stablecoins, and you can earn comparable rates in traditional finance now that the Federal Reserve has raised interest rates and treasury yields have increased. So given that, I'm expecting that we'll see the stablecoin market cap to continue to decrease. And the question that I would watch out for is, can Tether, USDC, and BUSD handle the redemptions that are likely going to come their way? I don't know for sure if they can. It all comes down to how liquid their assets are. I believe they probably have the assets backing it, but do they have enough liquid assets that they could handle tens of billions of dollars of redemptions in a short period of time? I suspect this one is probably the least likely thing to happen out of all the things I mentioned, but it's something worth monitoring. And that's basically where I see the market right now. Let me know what you think. Which risks are you looking at? Are there any other key events of the past few days that I wasn't able to talk about? I have another video coming about the Federal Reserve interest rates, so I know I kind of glossed over that. But love to hear what you guys think. If you enjoyed this video, please like and subscribe. And until next time, this is Dynamo DeFi.